right. I'm so glad there were people here. Just a minute ago, there was like 4 people, and Mr. Bellotti is right up front, so that's delightful. I'm going to kick off the panel. My name is Vail Ross, and I am with STR, and I'm going to just give us a quick update of what are we seeing in total U.S. trends, where we've been, where we're going, reiterate a lot of the good information that we heard yesterday, and to share some insights, and then pass it on to the rest of the panelists. So with that, let's go ahead and get started. So kicking off where we were back in 2020, if you noticed, 2019 is not here. We'll talk a little bit about 2019, but to kick us off, let's go back to where we were in 2020 to where we are today. And from an overall stats on a nominal basis, our industry is doing incredibly well, specifically from an average daily rate and a RevPAR point of view. In the little white bubble is where we are with inflation adjusted. So while we've well exceeded 2019 levels on a nominal basis, from inflation adjusted, we are about 1% off from ADR and about 6% from RevPAR, so still have a little ways to go. So one of the topics which we heard from some of the panelists have been around supply. So just kind of talking through those key KPIs and the fundamentals of where we are within the industry. Going back to 2018 to where we are forecasting in 2024, supply is going to be a little bit of a growth cycle, still not where we historically have been. Historically, on a long-term trend from a supply standpoint, it grows about 1.4%. So we are forecasting that in 2023, U.S. Supply will be around 1% and around 1.3% in 2024. So starting to see some growth, but not extreme growth, and definitely will be kept in check, which will be good. From a new construction point of view, we are definitely starting to see that in construction and the final planning start to tick back up. Currently, there are around 160,000 rooms that are currently under construction. That is up about 0.6% from where we were this time last year. About 50% of those are in that select service segment. That has been a trend that really started in the downturn in 2008 and has continued, where that has been the type of hotels that developers are definitely more and more interested in. With that, what we are seeing, which does speak well to our industry and to the asset class of hotels and how we are a bit more resilient in an inflation-adjusted environment, is that in final planning, which means that essentially those properties will go in construction in about 8 to 10 months, and then obviously depending on the product, once they're in construction, it can take anywhere from 12 to 24 months to open. There are 219,000 rooms currently under construction, which is over 22% from where we were this time last year. So a good amount in that pipeline. Some of the top markets, Nashville, my hometown, is leading the way as it goes for the top 25 markets in active pipeline. The one thing that is a little bit different from a Nashville standpoint, that's different from the U.S. trends, is that a lot of that new growth is coming on that luxury side and upper upscale side of the segment. And it's doing incredibly well for the market and continuing to rise the overall average daily rate. So let's shift to demand. Looking back again, long-term, 2018, we can see what happened in 2020, and we're just gonna ignore that. And then keep going on to 23. We're seeing some strong demand growth, and we will reach all new peaks in 2023, which is key. And as Adam Sachs shared yesterday, if indexing it to 2019, we're continuing to see strong hotel demand growth for the total US. And month by month, we're continuing to get closer to peaks. So historically, the gray bar here are record highs, and for the majority of the months, those record highs were in 2019. There is the exception there of September and December of 22, where our industry hit an all-time high in room demand. And then in January and February, that all-time high was in 2020. But the story here is that we're continuing to grow demand, getting closer to those peaks. And what's even a better story, while the slide doesn't jump out and say, oh, group demand is back, It is definitely getting closer. So this is looking at group demand index to 2019. And as we can see, we're not back to those 2019 levels. But if we do look month over month, and if we were to look at this data, comparing it to this time last year, we are getting closer and seeing more and more improvement. And we hear that as well from all of our hotel constituents, that that group business is coming back and that it may look a little different. The windows may be a little bit different, but it is starting to come back, which is very important to those markets who are heavily reliant on that group demand, corporate demand. So looking at occupancy for the top 25 markets, places like San Francisco, Philadelphia, Minneapolis, New York, really have a longer way to go to get back to those levels that we saw even in 2020 from an occupancy standpoint. Markets such as Orlando, Dallas, Phoenix, doing quite well. From a long-term standpoint, for the overall US, in looking at the trend line of occupancy, we are becoming more and more stable, which is really where the KPI has the most area of improvement, is in this occupancy. So where we are forecasting 2023 and 2024, getting back to that point of about 65% occupancy for the total US and some strong growth, which is good and will be stabilized. We still have a lot of opportunity in that weekday, that Monday through Wednesday. Again, bringing back that corporate traveler, bringing back that group traveler is where we'll see a lot of opportunity as the year progresses. We will also see that highly benefit the full service properties. So historically, in the past couple of years, we've seen the most of the recovery in that mid-scale and economy segments. Where we have the most opportunity for some occupancy growth is in the full service, and we are projecting that we'll start to see some strong growth as we move to 23 and 24. So the golden child KPI has been average daily rate. It has historically not been the KPI that recovers the fastest in a downturn. This downturn obviously proved that to be incorrect. Again, we all know, driven strong by leisure, strong on weekend ADR growth, as well as those shoulder days, those Sundays through Thursdays, strong ADR growth for our industry, and that has continued to be the case. And while occupancy is not back on the weekdays, so Monday through Wednesday, we are continuing to see strong ADR growth in those days as well, which is overall elevating this strong KPI. And if we look at an inflation adjusted, second, third, and fourth quarter, we were pretty much right in line with inflation, a little lagging, but pretty much getting close. So the yellow line is nominal ADR growth, and blue bar is inflation adjusted. So continuing to get closer from an overall inflation adjusted standpoint. Looking at the top 25 markets, some of them are faring a little bit better than others. Vegas is through the roof, incredibly strong ADR. They have a lot going on. Group is definitely back, as we all know. There's been a good amount of supply, new product, but continuing to hold rate in that market. And really, from a nominal standpoint, out of all the top 25 markets, everyone except San Francisco have seen extremely strong ADR growth. On the flip side, with inflation adjusted, just a handful have done incredibly well and continuing to grow in an inflation adjusted standpoint. So with all that, RevPAR is doing quite well. We're still not back from an inflation adjusted standpoint. We need a little bit more growth there, but overall from a nominal, we have recovered well above 2019 levels. So let's go into the forecast. So we saw some of this data yesterday from Adam Sachs with Tourism Economics, and I just wanted to show it a little bit differently. This is the forecast in which we use for GDP on a quarterly basis. And there has been a correlation, and I don't think he mentioned this yesterday, but through our analysis, we have discovered that for every point of decline in GDP equals about 4 points of decline in hotel demand. So keeping this in check and taking this into consideration, obviously a lot of the macro noise that's happening, the overall fundamentals of our industry continue to be strong, and we do feel that that will have a positive impact on our forecast as we move into 23 and to 24. So with that, even with a small looming recession going on, we do suspect that we will see some positive growth through this year and next year. Not as aggressive as some of the other forecasts you'll hear today. We're a bit Where we've missed marks before is likely on the demand and the ADR, but not by much, a little bit more on the conservative side. This industry is continuing to impress us and drive that ADR. But with that, we are pretty confident that this year we will have overall RevPAR growth at about 3.7%. So not at inflation adjusted or inflation growth, but definitely some positive growth. And then in 2024, 6.6% RevPAR growth. Not getting back to real RevPAR terms from a 2019 comparison until 2025. Across the chain scales, nearly all growth there. We are suspecting that we'll see either flat to negative RevPAR growth on the economy segment for 23, but as we move into 24 and 25, incredibly strong growth. We have upped our forecast a bit on that luxury, upper upscale, and upscale segment with the thoughts and belief that more corporate travel will be coming back, group is going to be coming back, and that overall key international traveler who stays longer, spends more money, will be coming, and a lot of that inventory in which they oftentimes choose are in the gateway cities and are in these segments. So continue to see some strong growth across all of the chain scales. Looking at the top 25 markets, I think with the most growth are the markets that have the most growth to go to get back to where they were in normal terms. So places like San Francisco, Seattle, Washington, D.C., we are suspecting the strongest RevPAR growth for 2023. However, again, not back to where they were at all-time peaks. There's a little bit of thought as will there be a little bit of Florida fatigue that could have impact with Tampa and Miami. We'll see. They've still continued to be incredibly strong markets and each month over month continue to do incredibly well. With that said, we do suspect that we will have overall positive RevPAR growth in 2024 for all of the top 25 markets, pretty much around that, hovering around that 10% mark. A lot of that coming back for some of the occupancy component of RevPAR and overall ADR continuing to be strong. So for some quick takeaways, we do suspect demand is going to continue to be solid. We do not necessarily see that slowing down. We feel that leisure will continue, whether it peaks, maybe not, but it will continue to be strong. We will bring group back. We will have our corporate travelers start to come back. We're already seeing that. And obviously the international, there continues to be the need and the desire to be out and to travel. We do suspect that there will be some recessionary conditions, probably having a bit more of an impact on the economy and mid-scale segments. Again, due to what we also learned yesterday from our friends at Tourism Economics, more impacting the household incomes with $50,000 or less, which are more likely going to be choosing those segments. So a little bit of a slowdown on the select service side of things that the recession could have some impact. And then finally, 2023, to be divergent, however, mostly positive. And what we mean by that is there are going to be some markets that are seeing flat growth or negative growth from an ADR standpoint, but it doesn't necessarily mean that ADR is dropping. We have been in extreme high levels, and just to be able to sustain that is not necessarily going to be the case. So there will be some markets and some areas where it may feel like we're having a slowdown or where it may feel like it's not the most positive, but all in all, for 2023, we suspect that the U.S. lodging industry is going to have strong KPIs, and that will likely also continue into 2024. So with that, thank you. There is my contact information if anyone has any questions. We're not taking Q&A, but if any questions come up, feel free to email me. And thank you very much for your time. And I'm now going to turn it over to Cindy.
Thank you. Thank you, Vail. Good to be here. It's always good to see Jeff in the front row. There's a QR code if anyone wants to get the deck, so you can snap that. I have it in some of the slides. So I'll start right from the sort of the punchline, because everybody always wants to know the forecast. And we are also a little on the conservative side, probably a little more conservative even than STR. So we're looking at a 3.2% RevPAR growth this year, about half occupancy and half average rate. And where our forecasts, which we do kind of update every 2 weeks, are leaning more to maybe a little bit more strength on the ADR side, which ADR is resilient and sustaining in spite of everything that's going on around us. So I'm going to unpack RevPAR performance a little bit, and I'm going to talk more about segments and kind of get into length of stay and some of the details. I'll start off with 2022 performance, just to give an idea of what's happening with, in terms of how much it costs to get this revenue, which is another number that we like to track. So the guests actually paid almost $200 billion to the US hotels last year. We spent about $6 billion on wholesale commissions, which brings us to what we call hotel collected revenue, brings us to 185. Something we call COPE revenue, which is contribution to operating profit and expense, is when we take out retail commissions, transaction fees, loyalty costs. Those were about $10 billion last year. And then we take out sales and marketing costs, which was around $17 billion. So we spent, as an industry, about $32 billion to bring in that $191 billion. So we calculate something called revenue capture, which is like how much do we actually keep of what the guests pay us. And that number was 83, just a tad over 83%. But the previous year, it was 83.58. So we've lost 53 basis points since last year. And the pattern that we've had in just looking at our ability to keep the revenue that we bring in, we've been declining. So if we look even from 2015 to 2019, RevPAR kept growing and revenue capture was declining at a pace of about 25 to 40 basis points a year. So what happened if we now move into the next stage, move into 20 to 2022, again, we get into this healthy pattern where RevPAR is growing, but that can obscure some of what's going on sort of behind the scenes, which is what it costs to get that business. And it isn't, when I talk about these costs, the least of it is brand-related costs. It's really a lot of third-party costs. I don't know if we have third parties in the room, but it's an expensive marketplace that we're operating in. As you saw, we were spending $32 billion to get our business, and that's we only keep 83% of it, and that's on average. So we have lots of hotels that are only keeping 75% of it, and that number, if it keeps going down, it's not great. So we want to kind of keep tabs on that, and if we look at what the cost factors are, the business that comes property direct, which traditionally for kind of the middle and lower tier hotels used to be 70 or 80% of the business. We're now across the US at closer to, it's under 30% that comes property direct. But if we look at that as the lowest cost business and we index that at 100, we can see that brand.com business and voice business, which everybody says, oh, it's so expensive to get business through brand.com, and it is 3 times as much as the property direct. But compared to third-party business, we're talking, 5 to 8 times that cost. So, in terms of what we can do to try to get more direct business, that's always kind of the topic, and the question of what we can do to reinforce that direct business becomes really important. So if we look at the channel mix, brand.com has been actually very strong, and we're almost at 1/4 of the business in the US in 2022 was coming through brand.com. The OTA business, it looks like it dropped off. The truth is that OTA business actually grew from 21 to 22, but as a percentage of the total, because room nights grew like 11% and OTA business only grew about 2.5%, it appears to have dropped off. It's just as a percentage of the total. But that's not bad news for the hotel industry to know that brand.com remains strong and kind of resilient. Like, that's a good thing, and we want to keep that up. So when we look at what the forecast is, so that gray bar is the forecast, we expect brand.com to continue to grow, but so is OTA. And what's happened is that property direct business that used to walk in, drive in, call in, all of that, people are sitting in like parking lots and booking on Expedia or something, that happens all the time. So what we're seeing is a lot of the business is moving online electronically, but it's splitting between brand.com and OTA. And that's where the cost factors are. And it's just something that from a profitability point of view and asset value point of view that we have to be mindful of for operators and for owners. So what we see is the GDS business and the voice business is not going to reach in 2023 even 2019 levels, but the OTA and brand.com business has continued to grow. Property direct grew a lot during COVID because there was so much more interest in direct bookings. People want to call the hotel, they want to make sure, safety, cleanliness, all of that was met. So we had a big spike in direct business, but we've kind of dropped off, and it's now coming more through third parties. But we're back to that horse race between brand.com and OTA business. And it's something we really have to keep an eye on in the future, because that's where there are sort of hidden costs, because a lot of those wholesale commissions don't show up on the P&L, but they are in fact incurred. So when we separate the business between commercial and leisure, and when I say commercial, I don't just mean corporate. That's like government, contract crew, all the group business. So the red column is commercial and the blue column is leisure. And you can see for 21 and 22, you can see the growth. And that leisure business, the blue column, is well above 2019 levels. But it's kind of leveling off. And we don't see that it's going to continue. It can't keep growing at the rate that it was growing. The red column, grew back, but we still have, and a lot of the benefit this year in RevPAR is coming from the growth of some of that corporate business. But it's kind of a tale of two cities, because you can look at sort of middle tier hotels and lower tier hotels. They're at like 120 and 130% of 2019 levels. But when you look at the upper tier hotels, they're at like 70% when it comes to commercial business. So what we expect for 23 is that the corporate business and the commercial-based business is going to come back, but it's going to come back at a kind of slower rate, and probably will just meet 2019 levels. And we have, our interest rate's going to go up. I think there's an announcement this afternoon. What's happening with this bank issue? We have so much in the marketplace right now that is uncertain that we just don't know what's going to happen, and which is why our forecast is a little bit more modest. So it's sort of a messy looking chart, but if you look at the green and the gray line, that actually represents specifically the corporate business and the group business. And the corporate business is green and the group business is gray, and that black line across is 2019. So corporate specific business, not commercial with everything in it, but just corporate, at the upper tier, again, is running like 70% of 2019 levels. But at the lower tier, it's kind of picking it up. So it's not really fair to kind of combine them, because the combination just doesn't make sense. But we still are seeing corporate and group as not quite reaching 2019 levels. And that's kind of where the weakness is in the industry. And I'll show you some more data that kind of points out how that plays out. So one of the things about corporate business is it's changed its behavior a lot. So it used to operate where a lot of that came in through more traditional channels. It came in through GDS, and travel agents booked it, and a big dominant part of it was coming through the travel management companies. It's just not working that way anymore. So even at the upper end of the market, that business has sort of diffused, and some of it's coming through brand.com, some of it's coming through voice, some of it's coming through rack bar and other rate categories. So it's just, the behavior's changed, and we just aren't controlling it the same way. And there's a lot of third parties that are out there, like Kayak and Booking.com and others, who are trying to gather some of that corporate business. Again, it's not so great for the hoteliers, because they're just going to add cost for us to get that business. So a lot of the brands are taking initiatives to try to get that business direct, and I think ideally we want it to come in through brand.com. And a lot of that business is moving that way. There just has to be incentives to make it attractive for the traveler to want to do that. But we are down to the point where corporate business is less than a third coming through GDS, which nobody would have guessed that, because it used to be like 70 or 80% at one time. So the world has changed quite a lot. And so when you think about all these costs, what this chart shows is what the guests are paying for each of those channels, and then that's the black number at the top. And the white number shows what the hotels are actually keeping. And just comparing 2019 to 2022, it used to be, when we did this in 2019, that brand.com and GDS were almost exactly the same number. But in 2022, actually the brand.com number, when we take all the costs out, are 28% greater than OTA business, and 11% greater than GDS business. So that's really good news because the more direct business, the more profit, the more flow through, the higher asset values. That's kind of how it works. So what we're seeing is the behavior has changed by consumers in the market, and we really want to keep an eye on what we're actually keeping instead of just what the guests are paying, and we want to try to get business through those channels where there's more flow through, so we have higher asset values. So if we drill into brand.com and we say, well, what actually is coming in through brand.com, we can kind of unpack that. And one of the really, to me, good news is that we've had a really significant growth in the portion of brand.com business that's coming through the loyalty member rate programs. And that's impressive because those programs that were started, in earnest around 2016, nobody knew if they would really take hold, but they have. And a lot of the business, some of it is at the expense of rack bar, and some owners might say, oh, we're just trading off, and now it's getting discounted. But even that loyalty member rate business is coming in at a premium of 9 to 10% higher than OTA business, just as an example. So you kind of have to look at it on a net basis to really make that judgment and not just assume that, oh, it's discounted, so it has to cost just as much. It's just not what the data's showing. So if we look at how these loyalty programs, and you can see some of the other interesting points, advanced purchase has grown, and long-term stay has grown. And I'll talk a little more about length of stay. So if we look at brand.com, and I told you earlier it was almost 25%, almost a quarter, 24% of total demand, you can see that it tracks with the loyalty contribution. So we're almost back to exactly the same loyalty contribution that we had in 2019, which was about 50%. And again, that's a really healthy thing. And we have things coming at us in the future that will challenge that. Some of the banks and credit card companies are coming in with loyalty programs, so that's another topic for another day. But in the meantime, we're in much healthier shape in terms of that loyalty contribution, being able to flow through and actually contribute to asset values across the US. So when we look at the OTA business overall, and we look at the top markets that have produced, of the top 50 markets, there are 17 of those markets that actually have produced above the national average, which is just about 18%. When we did this in 2019, there were about 15 markets that produced above the national average. So yes, the OTA business is picking up, but the brand.com business is kind of giving the third-party business a bit of a run for its money. And if we compare, you can see in certain markets, we always had brand.com at a higher percentage than OTA. And for the first time, we actually have 2 markets in 2022 where the OTA business surpassed the brand.com. And that's Orlando and New York, which isn't a surprise. It was always a bit of a close call, but in 2022, they actually exceeded that. So in looking at how the business has played out, in terms of day of week, this is 2022. You can see 2021 and 22. And you can see that occupancy, that black line is 2019. The occupancy, we still, for every day of the week, have not reached 2019 levels by 2022. And if we look at average rate, every day of the week exceeds 2019 levels. And when we combine it and we look at RevPAR, Thursday to Sunday has exceeded 2019 levels, which made me really nervous when I saw this chart, because I thought, can we live on Thursday to Sunday? Like, for an industry that's lived Monday to Wednesday as our bread and butter, can we live on Thursday to Sunday? Like, is this sustainable? It still persists, so I feel okay about it, but I'll feel a whole lot better when, we can be in better shape when Monday to Wednesday starts picking up a little more. And those big corporate accounts that filled Monday to Wednesday, they're really nervous right now because of the banks. So I don't know how quickly that business is going to come back. And those are kind of the Fortune 1000 companies. But again, the local and regional accounts are producing, and they're traveling, and they're healthy and good, and everything is fine. So we just hope that regionally there aren't things that undermine it, because we kind of need Monday to Wednesday to come back a little bit stronger. So speaking of days of the week, we've got length of stay, and we can see that we actually, for the first time ever in the time we've looked at the data, length of stay grew 11%, which is really amazing to go from 1.9 to 2.1. It seems like just a couple points, but it makes a huge difference in terms of, even the costs, and everybody's very labor focused now. You'll hear more about it from Robert. Everyone is labor focused, but longer length of stay means we don't need as many customers. So even though demand is back and everything looks good, we've actually attracted fewer customers. Thank God they're staying longer, and that's the reason why we have the demand levels we do, because the longer length of stay means less cost in housekeeping and other things. So like the economics are better. And when you unpack that length of stay, you can see kind of, we still in the 1 to 6 night stays are still below 2019 levels. All of the growth in length of stay came from the longer stays, and we had at the, kind of 15 plus, much greater growth. Now, of course, that's a smaller volume of the total, but it was enough to make the length of stay on average go from 1.9 to 2.1. So just looking a little bit geographically, what we're seeing here, we track 975 submarkets, and 750 of those 975 on a guest paid revenue RevPAR index actually are at 100% or greater of 2019 levels, which is, and we've tracked this all through, since COVID. 200 of them are between kind of 70 to 100% of 2019, and there's only a handful that are below 70%, and we know which ones they are because Phil showed us that list of those big markets. But the one thing you have to look at is when you're thinking about markets, you really have to look at it by submarket because the behavior within any market is so different. So I just decided to look at Atlanta because we're in Atlanta. And you can see that when we look at the 15 or 16 submarkets that we track, the behavior just from February, and that blue part is our forecast, but the behavior varies from a low of 67% of 2019 to a high of 133%. So even within the same market, the variation is so great. Like you have to look at what's happening in a particular submarket at a particular tier to see what's happening with the hotels there. And if we just take downtown, because we're in downtown Atlanta, you can see that downtown as of February was at 74% of 2019 levels, with a forecast that between May and October, it actually should reach 2019 levels, and then before it kind of drops off again, so it won't sustain that. And if we want to understand why, we can kind of drill in and say, oh, corporate was only at 82%, and group was at 57% of 2019 levels. Of course, that's the reason why the submarket is not back to where it was, because when you unpack it, you realize that some of the core business isn't here yet, hasn't come back yet. But yet there's submarkets that are doing incredibly well. So it's hard to kind of blanket average things because nobody really lives at the average. You kind of live on your street corner where your hotel is, and that's sort of what matters. So just summing it up, since the recovery started, the averages can be very misleading. The dependence on commercial business is probably going to be the largest driver of how we do in 2023. And if all of these kind of headwinds that we have economically persist, it's going to be a little tougher for that corporate business at the high end to come back. But it doesn't mean at the middle and lower tier they're going to be suffering, because a lot of the local and regional businesses are kind of doing okay, and those hotels are doing really well. So the longer length of stay is really encouraging. The shoulder periods of Thursday to Sunday looks like, or Sunday and Thursday nights looks like it's going to be sustained, which is really good. Leisure will continue to contribute, but it's not really just leisure. It's kind of this combination, which I won't say that word that people use for the combination. But I think that the ADR growth will continue, but it's going to plateau. I don't think we can continue at the same rate that we have. So thank you very much. I appreciate your time, and I will turn over to Robert.
Great. All right. Well, thank you very, very much, Cindy. And thank you to Vail and Cindy for sort of setting the stage for what the marketplace looks like, what's happening in terms of OC, ADR, and RevPAR. What I'd like to do for the next few minutes is take a stroll down the P&L statement, look beyond RevPAR, talk about total revenues, talk about expenses, and courtesy of my colleague Celeste, talk a little bit about profits, something good to hear about in this industry, especially what we dealt with in, after 2020. If we could sync up the confidence monitors, please. Anyway, okay, so you're going to get a copy of these slides. This is just our forecast, same basics. There's going to be some fall off in economic performance during the latter half of 2022. That mutes demand, occupancy recovery occurring later and lagging. We talked about how inflation, amongst other factors, helped us push average daily rate and rooms revenue, but inflation also has impact on operating performance and profitability and operating efficiencies. During the first half of 2022, we saw profit margins, despite the fact of rising inflation, exceed 2021 first half levels, albeit not a great comparison. 2021 first half was not all that great. But with persistent inflation through the second part of 2022, it became more of a struggle. And we actually started to see the emergence of GOP margins or efficiencies starting to slide, margins less than that of comparable month during the second half of 2021. But by the end of the year, as a whole, we did see some significant increases in profit margins for 2022 across most parts, or most property types, but we're still falling short of 2019 levels in terms of efficiency. So now, not only is the industry benefiting from some good expense control in terms of improving profitability, but it's also a bit of a revenue story. So we all know, based on what Cindy and Vail said, RevPAR's come back really, really strong, driven by ADR, but we're starting to see some contribution to profitability and revenue growth from other sources. So here we're looking at the food and beverage department revenue, comeback in revenue stronger than RevPAR growth, driven by banquet revenue, which is very much consistent with that return of group business. Banquet revenue tends to be more profitable, so we saw improvement in F&B department margins and contribution to the bottom line as well. Food and beverage revenue growing for top line, enhanced the profitability within the department, helping the bottom line. Other sources of revenue that have come back, albeit minor, resort fees getting a lot of attention these days, cancellation and attrition revenues. Again, coming back, not major sources of revenue overall, less than 1% for all hotels, but those hotels that do charge a resort fee, it can be a significant amount. I thought cancellation and attrition was actually pretty interesting, greater than 2019 levels. So while group business is coming back, I think what this is the fact that while groups are being booked, maybe the attendance at the groups is not really coming back, hence the rise in attrition. Attrition not only earned because of lack of pickup on the room side, but we're also seeing some food and beverage attrition. So, those banquets events planned by the groups, lack of attendance, that revenues, not attendance are not there, hence hotels are earning those attrition fees. So for total revenue, again, comparing it to 2019 levels as a whole, just like RevPAR returning in 2022 to pre-COVID levels, we're also seeing total revenue roughly at 100 to 101% of 2019 levels for most property types. Going down the P&L statement, starting with other operating departments, these tend to be more variable expenses, so we look at them in a dollar per occupied room basis. And as you see, during the second half of the year, as inflation started to decline, and occupied room growth compared to prior year also started to slow down. We did see some good control of expenses during the second half of the year in these operating departments. Within the operating departments, you'll mostly find labor costs, biggest expense for a hotel, close to 50% of all total costs of a hotel. And what you'll see over time is that hotel managers in general have done a very good job controlling labor costs, faced with varying and fluctuating revenue levels. Always been within that tight margin, roughly 30 to 35% of revenue. But what we're facing now and what we're seeing is this dual threat. Lack of available labor, increasing labor costs. So if you combine some of our data, total labor expenditures, salary, wages, benefits, combine that with some Bureau of Labor statistics regarding average hourly compensation, total compensation for hospitality employees, you can make some assumptions about hours worked. And so what we found is that in 2022, what the data implies is that there were fewer hours worked at the average hotel in our sample compared to 2019. And that makes sense. the lack of available labor, cut services and amenities. And I think we can all agree that for the most part, hotel managers have done a good job learning to do more with fewer people. The problem is with those rise in wages, we're paying more for that. We're paying more in salaries and wages on a nominal basis compared to what we did pre-COVID, and we're getting fewer hours for that. Not the best productivity from a dollar measure. Continuing further on down, undistributed department expenses, mostly fixed in nature. We look at those on a per available room basis. Some decline during the second half of the year in terms of pace of growth, but not as great as those more variable operating department expenses that we saw. Within the undistributed operating expenses, we see rises in A&G and sales and marketing department, but that makes sense because in A&G we've got credit card commissions, and the sales and marketing department we have franchise fees, both tied to gains in revenue. So with revenue growing, we had gains in these expenses. Not a bad thing, we can live with that. But then you got expenses like utility departments growing 21% in 2022. Rising expenses, again, energy costs, the cost of energy during the first half of the year on the rise, in fact, on the rise at a pace greater than occupied rooms. But during the second half of the year, as energy prices started to taper off a bit, we did start to see some declines in this expense. Unfortunately, if you look at some forecasts of what energy prices will be going forward into 2023, it's comparable to what we saw in December and November. That implies that we're looking at around 15 to 20% increases in energy costs again in 2023. So that's a tough one. That takes us down to the gross operating profit level. And if you remember, while we had revenue recovery for the hotels in our sample, not quite back there in terms of GOP profits. Slightly under our 98, 99% of 2019 levels. Now, since this is an ownership and investment conference, let's keep going down below gross operating profits, get into those more fixed expenses, those that are paid by the owner, looking at property taxes and insurance here. Property taxes, 2021, property tax appeals based on poor performance in 2020 seem to have been taken into effect. We saw a decline in the actual amounts paid for property taxes, ticked up a little bit in 2022. But insurance costs going way, way up. And again, if you look at the forecast for commercial insurance, liability, and property taxes, that's going to be in the 10 to 15% range again in 2023. So another cost that, it's just going to go up. It tends to be more fixed in nature. Not a lot we can do about it. Of great interest to owners is interest expense. So we looked into our database. There are 420 hotels for which we have interest payment data consistently from 2019 to 2022. So we did some analysis of that data. What we found that, interestingly, in 2021, interest payment expenditures for the owners is actually down from 2020. Lower interest rates, yes, but I think a lot of it is also an inability, just not the cash to make the payments, so maybe some workarounds with your lender, and just the inability to make interest payments, so you pay less. But I think what was more interesting is when we start looking at our EBITDA line, or cash from operations, how are we able to cover it? Do we have enough cash to make our interest obligations? Pre-2019, the average coverage ratio, 2.1, 2.5, over 90% of hotels were able to make those interest payments. Obviously, in 2020, given market conditions, that fell off dramatically. Our ratio, less than 1%, implies that the vast majority of hotels didn't even come close to generating sufficient cash to cover their interest obligation. Only 24% of the properties in our sample were able to achieve that. Things improved in 2021, improved again in 2022. But I think what's interesting here, if you look at the 2022 statistics, 2.5. So an interest coverage ratio, back to pre-COVID days, but only less than 90%, and only 86% of the properties in the sample were able to achieve that. So I think it's sort of that have and have nots. If you had a good year in 2022, you had a very good year. You really, generated cash, you paid for your interest, you were able to cover that. But there are a lot of hotels that still can't do that. So there's still some suffering in the industry. Profit recovery. So to sort of answer the question, when are profits going to recover? We went into the Wayback Machine. What we saw is prior to 2000, if you look at recessions, there typically was a noticeable lag. Profits would recover maybe 2, 3, 4 years after we saw revenue recovery. But since 2000, that's changed. Profit recovery maybe 1 or 2 years after revenue recovery. And we think that's going to be sort of a similar situation what we're going to experience now. We recognize, that there's still going to be inflation. We looked at those rising utility costs, those rising insurance costs, the rising labor costs. That's going to put margin pressure in 2023. So hotels may not be quite as efficient in 2023 as we were in 2022, but we think that's going to reverse itself and we're going to see margins recover come 2024. What does that do for actual profit dollars? Well, if you remember, we're forecasting some nice revenue growth in 2023. We think that that revenue growth from a dollar standpoint will overcome the inefficiencies. So you still will have some profit growth, profit recovery in 2023, despite the margin challenges in 2022. So to sum everything up, slowdown in the economy during the second half of 2023, mutes demand growth, occupancy recovery delayed until 2026. As was discussed before, that strong average daily rate, that wonderful KPI, drove that RevPAR recovery in 2022. We also saw the increases now finally returning in terms of other revenue sources. So total revenue recovery in 2022. Margin pressure, inflation, still going to be an issue in 2023. But because we're getting some good revenue growth, that'll overcome some of the inefficiencies. So we'll have profit recovery in 2023, 1 year after revenue recovery. And with that, I'm very happy to hand it over to my friend Jamie.
Thanks, Robert. I want to start, introducing myself. My name is Jamie Lane. I'm a VP of Research at AirDNA, and we are a short-term rental data and analytics conference. And I really appreciate the Hunter team for inviting me here to talk about short-term rentals and some of the trends that we're seeing and maybe how they're relevant to you all as hotel operators, because short-term rentals have really seen all the best trends that have been happening, sort of really over-indexing on leisure, long-term stays, and maybe can give you some insights into some broader trends happening in the leisure travel sector. And also just want to start by saying how much of a pleasure it is to be on stage with Robert, who I worked with for more than a decade, and then Cindy and Vale. I'm working extensively with their data sets, forecasting them for years, and really a pleasure to be on stage with you all. That really gets me to how I got to be at AirDNA. So what I've done here is shown a chart of the average number of listings, or number of listings over the past history of Airbnb. And they started in 2008. And as a forecaster for the hotel industry, they're really sort of operating in the dark. Or we were operating in the dark of not having a good sense of what their supply was, what markets were they in. And that really changed when AirDNA came onto the scene in 2015, where we really had our first visibility into what was happening in the sort of shadow supply, alternative lodging sector. And we were surprised in 2015. I remember sitting with Mark, and we first got our hands on the data set, and we're like, oh my God, there's 100,000 listings. This is massive growth that we're seeing. And you fast forward to today, we're at over 1.3 million listings in the US just on Airbnb. And at AirDNA, we track both Airbnb, Vrbo, Booking.com, 120,000 international markets, 12 million listings, 6 trillion data points now collected over 8 years. So we're now building that sort of good time series of data. And the industry has grown substantially. Global short-term rentals generated $148 billion in 2022. To give some context, that's about 14% of overall paid accommodation. So a growing piece of the sort of accommodation pie. Most of that, we're seeing about 50% in North America. And then a quick view on just the global recovery of short-term rental demand. So throughout the world, we've seen varying different recovery patterns. aligning very closely with what we've seen with hotels. But for short-term rentals, demand actually got back to 2019 levels in 2021. So well before the hotel recovery. And we're sort of pushing further into expansionary period now. While Latin America, while was down, has now surpassed North America, and APAC still broadly recovering. So that's sort of give a backdrop. And now I want to get into 5 trends. And my former boss, Mark Woodworth, sitting here up front, always told me about when talking with hotel operators and hotel investors that you have to keep it simple and talk slowly. So I'm going to present this data today in 5 trends. And I'm hoping everyone can maybe take 1 or 2 of those trends home with them today. And we're going to start with flexible travel. And I've got a personal story here, because when I started at AirDNA in October of 2020, I had full plans to move to Denver, where our headquarters is. But then, 2 days later, after leaving CBRE, we found out we were pregnant with our second kid. And Elliot was so excited to move to Denver. But with Adrian being born, we sort of put that on hold. Our parents, my wife and I, are both in Atlanta, so we decided to stay here. And what that meant, though, was extended periods of travel, and we spent a month in Denver last year in an Airbnb over the summer. And we're seeing that sort of trend of flexible travel, flexible work, digital nomads really play out in the data. So this is data from Airbnb, where they track nights booked and the percent of nights booked that were for 28-day longer stays. And where pre-COVID that was about 14%, now we've seen it consistently higher than 20%, even to today. So that's, as I said, digital nomads, construction workers, traveling nurses, doctors in residency, and really the great migration happening and a lack of available housing stock, people moving and needing temporary housing that short-term rentals have really been able to accommodate. We've also seen wild seasonality trends play out throughout the short-term rental sector. We saw record high occupancies in 2021 as supply contracted and demand accelerated. And really travel patterns that just didn't make sense given historical seasonality. So people going to Coachella Valley throughout the entire summer, people traveling to Cape Cod in the winter, and now we're seeing a reversion of a lot of those travel patterns. We're seeing supply come back really strong, and we're actually seeing, for short-term rentals, we've seen a full year now of occupancy starting to contract, which I know is in stark contrast with what we're seeing in the hotel industry. Trend number 2 is flexible search has opened more destinations. So Airbnb has changed the way people search for travel. Where on the traditional booking sites, we start with our destination we're going to and the dates we want to travel. Airbnb has sort of flipped that, of where you can tell me when you want to travel, roughly the season, maybe a region, maybe the month, and they're going to suggest destinations near you, and the best type of properties that support the type of travel that you want to doing. And what that has meant is maybe areas that you would have never meant to search for in the past are now popping up. And we've seen the growth in demand, and that's in that blue line. And this is small towns, rural areas throughout the country, where demand is now 150% higher than 2019 levels, and has continued to accelerate throughout and even today. And it's our fastest growing segment in both supply and demand. We also see destination areas, mid-sized cities, as some of the fastest growers in terms of demand. That's strong demand has translated into increasing supply. And in small city rural areas, we have seen a 56% increase in supply in those areas. That is the strongest growth by location type. And then you look on the far left, that's urban. We've actually seen a contraction in urban supply. And we're going to get into a bit more of that detail in the next slide. But it really impacts how maybe hotels you should be thinking about the short-term rental sector. And that goes into our number 3 trend of supply growth that's lagging in the major gateway markets and actually booming throughout many parts of the world, especially Texas. So on the far left, and now this looks at trailing 12-month average available listings compared to 2019. And many of those top 25 lodging markets, so Boston, New York, Oahu, San Francisco, Los Angeles, Oakland, Seattle, all more than 25% below 2019 levels of supply. Market like New York, almost 50% fewer listings today than at the start of the pandemic. We've really seen a wholesale shift in the use cases of these homes, of these apartments, away from short-term rentals towards long-term rentals. And given the regulation in these markets, we are not seeing supply come back. And even with the sort of strong demand growth now in these urban areas, with international travel coming back, we're not seeing supply recover as quickly as we expect. And overall, urban recovery still very much lags. So we see demand in urban areas still 15% below 2019 levels, where outside of the urban core, we're actually seeing some decent growth now. In the suburban areas, demand had fully recovered as of the beginning of 2022, and is now getting into that acceleration mode, where you see on the urban side, it's really plateauing. And unless we get the supply back, we're not going to get the demand to fully recover. And in some cities, it may never fully get back to 2019 levels. Trend number 4, many of you may not have heard of this term, Airbnb bust, but it's sort of has its own media narrative around it. Sort of centers, I think, a lot around the supply declines that the industry's seeing. But broadly, we're seeing really robust demand. And in terms of just any crack showing in leisure demand, we're not seeing it. So we're going to show demand in 2 different ways. One, in terms of nights booked. So based on the date when people are actually booking that reservation, not when they're staying. And this gives us a great sense of forward demand. So how many people are booking today for any future period, and how does that compare to how many people and how many nights were getting booked in prior years? And we're seeing really robust growth. So 15% growth in February, hitting record highs week after week, month after month. On the stayed side, so how many nights are actually being stayed in these weeks, in these months, we're seeing really robust demand growth too, 18% growth year over year in February. So we have switched in the sector from indexing to 2019 to broadly indexing year over year and consistently about 20% demand growth. As we look forward, so on the books, as we look out over the next 6 months, and the dark blue line is what's on the books as of today. So what's been booked for stays in those months compared to what was booked as of last year. And we're seeing forward demand pacing about 10 to 12% higher as we get into spring break and through summer travel. So very robust growth as we look forward. And then trend number 5, our last one, is the competition between hotels and short-term rentals. And this is an extenuation of some research we did with STR last summer. We're going to do an update of it for the Hotel Data Conference in August. But what this looks at is total paid accommodation, so how much demand is staying in hotels and short-term rentals, and the share that short-term rentals are taking of that overall demand. And from 2018 to 2020, we had seen really robust share gains for short-term rentals of total accommodation. That really spiked during the pandemic. You see that went up to over 16%. But then as hotels started to recover really strongly throughout 2021, we actually saw that share gain drop to essentially pre-COVID levels. So it was 12% pre-COVID, 12% as of March of 2021. And now we've started an entirely different path of share gain. See that sort of slope where it had been growing about 2% a year. Now we're growing about 1% a year. So much slower growth. And a lot of that has to do with the urban supply, where short-term rentals are just not growing urban supply as much, not able to take the urban sort of shares as much as they were. And we're now back below 2018 levels of urban share for short-term rentals. So an entire 5 years lost of share gains. The big competition piece that I hear most closely, though, is on price. And price is a tricky one with short-term rentals, given that the homes that are available today aren't necessarily the same homes that were available last year or the year before. And we've seen a really dramatic shift in the types of units being rented. And that's what it shows on this chart on the right, sort of the occupancy change pre-COVID to today. We're seeing much more homes being rented, the larger homes, sort of 3 to 5+ bedrooms, much lower occupancies in the shared rooms and private rooms. And what that means is we've got to create a way to account for that in price. And if you just look at our standard ADR, so taking revenue divided by demand, it shows that ADRs are up 30%. But a big part of that is the shift of more larger homes being rented today than in the past, less smaller rooms being rented. So what we did was we created a repeat rent index that essentially compares the same homes over time, so we get a real clean comparison. And when we look at that, ADRs are only up 18%. And when you think back to Vail's slide when she showed the nominal growth in ADRs for hotels up roughly 16% over that same period, prices are roughly in line. So it may seem like short-term rental prices are maybe higher and they're not competing as much on price, but in reality it is, and the price gains have been roughly comparable across the two sectors. Now I'm going to end 2 bonus slides, questions I got from the other panelists. One was on home prices and short-term rentals and its impacting on home values. It's a really controversial subject. One and tourism economics we've looked at, and essentially short-term rentals are a piece of the pie, but a very small piece. Tourism economics proved out that of the 15% gain in home values that had happened, only 1% was some short-term rental inventory. Most of it is from sort of broad income gains, job gains, and household formations. And really we got a peak of that during the pandemic where short-term rental supplies were falling across much of the areas of the country. And you can see that in that chart, down 25% in Nashville and Austin, where home values were accelerating. And now we're in a piece where short-term rental supply is actually increasing and home values are coming down. They're actually totally disconnected now in terms of the overall trends. And then bonus slide number 2 is our forecast. So very different view of the outlook for the short-term rental sector. We actually have RevPAR declines forecasted for this year off of a pretty big decline in occupancy, about 2% for the year. But you just look at those gains on supply growth and demand growth. So supply expected to be 13% higher this year rather than last year, compared to 25% supply growth last year, and then 10% increase in demand. So we do expect further share gains for the short-term rental sector. I appreciate all your time here. My contact's above. I'll be here all day if you have any questions.